Fear of AI replacing software makers hit stocks. Here's what to know. This week, a wave of selling on Wall Street took market participants by surprise, with software companies and the funds that back them sliding hard on a new set of tools that makes the threat of AI displacing established businesses feel more immediate. For years, AI has been the fuel behind the record-high rally in tech, but this time the evidence that it can undercut Grundeat's sacrificing to degrade a whole industry. In the space of a few days, that undercurrent turned into a shock. The trigger? On Tuesday, Anthropic, the San Francisco-based startup, released a set of free plug-in software tools. These tools let businesses automate routine functions, think customer support, legal research, and other back-office services. Because they are marketed as open source, any company can download them without paying for a subscription. The impact is clear. Companies that today sell software or subscription services could be replaced by a set of inexpensive, AI-driven alternatives, and investors have taken that to heart. When a cluster of cloud infrastructure and SaaS monoliths drops off the chart, it ripples through the rest of the market. Software industry returns have been a major part of the broader equity rally. But after months of growth and optimism, the prospect that AI could wipe out jobs and business models has started to claw back the confidence that had seemed boundless. Investors are no longer just excited about the growth promised by new AI ventures, they're weighing the real-world disruptions that could be coming in questions of licensing costs, job displacement, and whether capital budgets will be absorbed by new AI projects instead of revenue-generating software. Capital spends are sky-high this year. Amazon announced it will spend $200 billion on AI and related initiatives, a $50 billion jump above estimates. Alphabet said it will spend up to $185 billion this year, while Meta last week disclosed capital expenses that could hit $135 billion, mostly to support AI. Those numbers aren't T-spin, they illustrate how firms are ready to outspend their competition and how that can suddenly change the value proposition of every SaaS billable hour. A company that once had a predictable subscription stream can see margins collapse if its customers can replace its workforce with a plugin that costs a fraction of the price. The market reaction was double-fold. The S&P 500 fell sharply through the week, lost week's gains on software stocks and private credit houses that provide funds to those firms. By Friday, the index clawed back about 1.8% in one afternoon, indicating a brief rally, but the weekly losses in software stocks reaffirmed the persistent fear that AI's impact is bigger and deeper than ticker symbols can capture. If you want to keep an eye on who really is responsible for the damage, it's worth noticing the distribution of where the threat sits. The biggest risk is for companies that provide subscription-based cloud services, SaaS, because once an AI plugin can offer the same function for free, the value chain shrinks. Those large, headline companies that dominate the top of the stack are hit first because their complexities and brand loyalty keep disruption largely out of the way. Once a plugin shows that a business process can be automated cheaply and at scale, the raison d'etre of the SaaS firm is eroded. And that's not even the full story. The second wave of impact will be on the investment funds that supply debt to these software firms. Credit markets have already felt a pull, and if the staircase of AI keeps climbing, the fundamentals may change. Long-term debt performance could be challenged, further tightening funding and accelerating the downward spiral for software vendors. So what does this all mean? For investors, it's a warning that the wave of AI improvement is double-edged. It is still a source of enormous growth potential, but it also carries the potential to make the very businesses it fuels obsolete. For companies, it's a call to reflection. Can your product or service be matched by AI-driven, subscription-free tools? Can your margins survive if a customer can get the same service for a few dollars a year? We'll keep following this story as companies respond, regulators weigh potential implications, and the market shares the AI truth. In the meantime, it remains essential to evaluate how AI is altering not only product lines but also the very economics behind software. Thanks for joining us today. Stay tuned for more analysis and market updates.